So we just saw like what drives ROE. So you also got to understand the risk profile for bank before you consider an investment. Okay. And there are three broad risks that are there in a bank. Broadly, so there is credit risk, there is interest rate risk, there is liquidity risk. Okay. So credit risk is the most talked about risk. Okay. That is, you look at NPAs, non-performing assets. Okay. And also you leverage also kind of gives you an idea. If in case things go south, if the asset quality goes down, then your equity could be wiped off. Okay. So both leverage and the NPAs, they give you a view of the credit. Uh, More so, it's the NPAs which give you a view of the credit risk of the bank. Okay. And if I just share my screen and show you where you can see it, let me move it. This is the ICICI ka latest investor presentation. So here you just go there and just type NPA. What's happening? Okay. So if you look at gross NPA, it's look at gross NPA, it's 2.3%. So if it's like 2-3%, that's fine. So lower leverage and lower NPA. Okay. So you get a you kind of make an assertion on the credit risk profile of the bank. Okay. Again, not going into a lot of details, just intend to keep this video short. Okay. So this is about credit risk. Then the second risk is the interest rate risk and the liquidity risk. Okay. So for that, the interest rate risk, let me talk through some of the crises that have taken place in the recent past. Then you'll be able to understand it better. कि हुआ क्या था? Let me talk about an Indian example, then I'll talk about a US example. Okay. So in September 2018, August, September 2018, there was this financial institution called IL&FS. Okay. And something happened with that bank, which was called asset liability mismatch. Okay. So let's understand what is asset liability mismatch. Okay. So when you have financial institutions that engage, say, in short-term borrowings, yani liabilities, when they engage in short-term borrowings, okay, to give long-term loans advances, loans, matlab assets. So when they engage in short-term borrowings to give long-term loans to their customers, and what happens is that the FIs may not be able to pay off their creditors since the money is stuck in long-term loans that they have made to their customers. Okay. So typically what happens is these financial institutions, they roll over the short-term borrowings. That is, they make another borrowing to fulfill a short-term borrowing. But if they are not able to do so, okay, if they're not able to kind of roll off their short-term borrowing, मतलब एक और लोन नहीं, एक और बोरोइंग नहीं कर पा रहे हैं एक एग्जिस्टिंग बोरोइंग को फुलफिल करने के लिए, if they are not able to do so, then they face a severe liquidity crunch, which is called asset liability mismatch. Okay. मतलब असेट जो आपने लोन दे रखा है वो तो 20-30 साल का है, वो पैसा 20-30 साल में धीरे धीरे करके आएगा. Okay? लेकिन जो आपने वो लोन देने के लिए जो मार्केट से पैसा उठाया है, वो आपने बोला है कि आप वो 1 साल में दे दोगे, 6 महीने में दे दोगे. राइट. तो पैसा आपका आने वाला है देर में, लेकिन आपको चुकाना है वो जल्दी जल्दी. ओके. तो दोनों के टेन्योर्स, लायबिलिटी और असेट्स के मिसमैच हो जाते हैं. सो व्हेन यू बोरो short term and lend long term, okay, then you may run into asset liability mismatch. Now the question arises, why financial institutions they engage in short term borrowings in the first place when they may run into asset liability mismatch. Okay. The reason is, see, short term borrowings are cheaper than long term. Okay, why is it so? Because long term borrowings, they have a higher interest rate. Since the providers of capital, they want to be compensated with a premium for bearing more risk, which stems from a longer term loan. तो short term cheaper होता है. लेकिन now I'm coming to the crisis that takes place. लेकिन if in case interest rate अगर बढ़ जाए, which is what happened in 2018, interest rate अगर बढ़ जाए, the short term borrowings also they become expensive, क्योंकि banks they have to pay a higher interest. So banks may not be able to take another short-term borrowing to fulfill an existing short-term borrowing. अगर interest एकदम से बढ़ जाए. Okay? And this is what happened in the case of IL&FS. Okay? They defaulted on a short-term borrowing. They defaulted on a commercial paper. Okay? Credit agencies, they downgraded the bank. This housing finance, this NBFC. Okay? So they were not able to raise capital at all. So it was a because they had this liquidity crunch. So they had to. So there was this ALM, asset liability mismatch crisis, that they had to go through. Okay. So ये एक इंडिया का एग्जाम्पल है, and asset liability mismatch can manifest itself into another form. So let me talk about a US example, which is very recent, which is the Silicon Valley Bank. Okay, वहां पे भी what happened is asset liability mismatch, but it took a different form. Okay, so what happened was the Silicon Valley Bank. Okay, they the deposits that they used to have was their nature was very concentrated. Corporate deposits, because Silicon Valley में है, तो Silicon Valley startups और technology companies और उनके employees और उनके वो corporations, वो companies ने अपना पैसा पार्क करके रखा था इस बैंक में. So very homogeneous, similar type of deposits. Okay, all right, concentrated deposits. Okay, and ये तो deposits मतलब liability की बात हुई. दूसरे side assets, in the asset side, what they had done is they didn't do anything like wrong per se. What they'd done is they actually uh, had invested in the asset side. They had invested in held to maturity bonds. They had invested in bonds. Okay, or held long term held to maturity bonds. Held to maturity bonds का मतलब okay कि वो long term bonds हैं. Okay, or they are not required to be mark to market. They had also invested in available for sale bonds. Okay, I'm not like getting into what is AFS and HTM bonds, but just अभी के लिए समझ लेते हैं. They had invested their money in some bonds which were not required to be marked to market. Okay, so और वो लॉन्ग टर्म थे. लॉन्ग टर्म जैसे लोन्स लॉन्ग टर्म होते हैं वैसे ये बॉन्ड्स भी लॉन्ग टर्म थे. सो व्हाट हैपेंड वाज कि 1.5-2 साल पहले when the interest rate they rose. Okay, so when you have a rising interest rate environment, then what happens is bond ka price it falls because the price of the bonds and the interest rate they have an inverse relationship. Okay, okay, so bond जो है वो गिरने लगा, तो हेल्ड टू मेच्योरिटी जो बॉन्ड्स थे इनके एसेट साइड में उनकी वैल्यू कम होने लगी. ओके, द गुड थिंग इज वाज दैट दे वर नॉट रिक्वायर्ड टू बी मार्क टू मार्केट, सो इट वाज अ नोशनल लॉस. ओके, ऑलराइट, लेकिन हुआ क्या ऑन द ये एसेट साइड की बात है. ऑन द लायबिलिटी साइड व्हाट हैपेंड वाज ओके liability side what happened was because market की कंडीशन इतनी अच्छी नहीं थी. So some companies, some startups, some Silicon Valley corporations, they started withdrawing their money. Okay, तो अब उनको पैसा देना है. Silicon Valley Bank has to obviously fulfill their obligations because depositors को पैसा देना है जो वो मांग रहे हैं. तो उन्होंने अपने assets को liquidate करना चालू किया. Okay, तो पहले उन्होंने अपने शॉर्ट टर्म वाले अवेलेबल फॉर सेल बॉन्ड्स बेचे. उसके बाद okay उन्होंने इक्विटी उठाई थोड़ी. they raised some because they knew that now they did not have a lot of money because they knew that they have to sell their HTM, their held to maturity bonds. Okay, and if they sell those HTM bonds, held to maturity bonds, वो उनकी वैल्यू इतनी कम हो गई तो उससे ज्यादा पैसा मिलेगा ही नहीं. The money that they'll get from those by selling those HTM bonds would not be sufficient because the value of those bonds have fallen down. The money that they'll raise by selling those bonds would not be sufficient to meet their liabilities. Market got wind. All the corporations, all those companies which had deposited their money started withdrawing their money. It was a classic run on the bank. And Fed had to intervene and whatnot. Okay, so this is another example of how ALM, asset liability mismatch, manifested itself in a high interest rate environment. Okay, now with that, so we understood pehle credit risk. Now we understood key interest rate risk, how it could manifest itself in different ways. And obviously interest rate risk hoga to liquidity risk ho jayega. Okay, so with that understanding, okay, हमें अगर इंडियन बैंक्स में किसी बैंक में भी if you want to make an investment, what should we look at? Let's understand very quickly. All right. So to check for asset liability mismatch risk, you would look at three broad things. Okay. So I have the latest ICICI investor presentation open. Okay. So first you search for deposit. Okay. Deposit meaning your liabilities. Okay. In the deposits, look for current meaning corporate deposits. Okay. So if you see corporate deposits for ICICI Bank is 11.5% as per the latest reported financials. For the Silicon Valley Bank, it was much higher. Okay. Because as I said, they had like very homogeneous deposit franchise, a homogeneous deposit profile. In the case of ICICI Bank and some other banks in India, it's very heterogeneous. Okay. Retail participation बहुत ज़्यादा है. Okay. So ideally, you should be looking for both kitta portion corporate deposits and what portion is retail. They do not explicitly mention retail, but ICICI, HDFC, it's like the retail portion of the deposits, it's more than 60%. Okay. So any which ways, look at current to corporate deposits, it's like 10, 11%. So it's not a huge number. Okay. All right. So basically, you're looking for heterogeneity, if that's the word. You're looking for heterogeneous deposit profile. Okay. क्योंकि Silicon Valley Bank में क्या हुआ था? Because the banks, the deposits was so homogeneous कि one guy took money, everyone followed suit. Okay. But it would be harder if the deposit profile, the deposit franchise is more diverse. It's more retail. Okay. All right. So that's one. Okay. The second thing, what you got to look for is go to balance sheet. Yeah, I think let me hit on 60. There we go. I am now looking for assets. Yes. Yeah. Okay. So here, right now, Abhi, what we checked for the, and I'm being super quick, guys. Otherwise, we can make like more detailed videos. Okay. So we check the deposit liability side. Now the asset side, what you got to check is what portion of your assets are actually your bonds, your investments. So here, if you see SLR money, statutory liquidity requirement investments, they are around 21% of your overall assets. Okay. All right. So as per the RBI norms, you're required to set aside a portion of your assets in SLR. Okay. So these are mostly government securities. So it's only 21% for uh, so for Silicon Valley Bank, the investment in bonds was more than 55%. Okay. And as we saw, Silicon Valley Bank, when the interest rate jumped up, the value of those bonds, they declined because the value of the bonds, the pricing of the bonds and the interest rate, they have an inverse relationship. Okay. So here you are kind of cushioned from that risk. Okay. Because the investment in bond is not that much. Okay. It's like 21% in government securities. And there are not only, and it's not all 21%, it's not in bonds. Okay. It would be in some other gold and some other assets as well. Okay. But any which ways, investment in bonds would be lower than 21%. Okay. So what it tells us is there is lower exposure. So low exposure to bonds, it limits the interest rate risk if in case interest rate were to jump. All right. So ये second चीज हमने check करी. This was the second thing that we checked. Now let's take a look at the third thing. All right. Okay. So the third thing would be, okay, now let me go to the annual report. All right. So I have the annual report open. Okay. And I'm just hoping that my screen is being shared. Yes. All right. So here you search on maturity pattern. Okay. Here in I don't know what happened. Maturity pattern. Okay. Let me. So here you have this table that opens up. So what you got to do is, so this has the asset and liability, okay, for all these maturity buckets. So as an analyst, what you got to do is you got to check if in most of these years, in most of these maturity buckets, whether the assets are sufficient enough to meet your liabilities. So that is what you got to check for these in each of these maturity buckets. Okay. And again, just giving you cursory inputs, can spend more time. Okay. If in case you guys want, just comment on the video. All right. So, all right. Now, All right. So until now, we've looked at two things. We've looked at what drives ROE, ROA, return on assets, and leverage. Okay. And I tried explaining as to what you should look for. Okay. You should look for high ROA, driving ROE, and not like high leverage driving ROE. Okay. That was a DuPont formula that we looked at. And then second is we looked at the various risks that you should assess while evaluating a bank. Okay. It's true for not only Indian banks, any bank that you evaluate in the world. Okay. Uh, and now let's talk about valuation. Okay. See, I'm very passionate about valuation. Okay. So I would make another video in which I would project out the three financial statements for a bank and value it using DCF. Okay. I'm a proponent of DCF. I know a lot of people do not like using DCF to value banks. That's fine, to each their own. Okay. But here in this video, I'll just focus on the relative valuation metric. Okay, which is the price to book metric. So let me share my screen and show screener. Where is screener? Okay. All right. So in the screener, I have these banks. Okay. So if you see, we look at this price to book metric, valuation metric. Okay. See, and why PB? Why not PE? See, for banks, usually PB metric, price to book, is preferred over PE, and there are like three reasons. One is because in PE, in the denominator, you have earnings. Okay. So earnings could fluctuate. Okay. They are a point in time earnings. So they could fluctuate. So your PE multiple could be distorted, could fluctuate. That's one. Second is the good thing about PB metric, price to book, is in the denominator, you have book value of equity. Okay. So in the book value of equity, it has historical earnings embedded in the book value in the denominator. Okay. All right. And obviously it's without the fluctuation. Okay. So and what happens every year, whatever profit these banks they report, they get added to book value of equity. So that's why it has a historical element to it, this PB metric, and it's not at a point in time. Well, it's a point in time, but doesn't have that sense because it's more historical than PE. Okay, PE is strictly a point in time. Okay, and third reason is see, analysts they closely track the compounding of book value per share. Okay, and book value per share compounding usually comes at the back of long periods of high return on equity. Okay, so it kind of goes back to what we discussed in the beginning, which was the ROE breakup. All right. So these are the three reasons why we look at PB and not why PB is a preferred metric. I should not say we don't look PE at all. I should say why PB is a preferred, price to book is a preferred metric over PE. All right. So now with that reasoning, so if you look at the PB metric for these banks, okay, ideally, okay, it should be, a bank is a bargain. It says it's said to be reasonably or undervalued if it's trading lower than 3. The P metric should be lower than 3. So if you see HDFC, it's lower than 3. That means it is priced to be a bargain right now. ICICI Bank is over 3. It looks expensive, a tad expensive. State Bank of India looks cheap. Okay. So what do you do? Would you go and buy the bank? Well, again, to each their own. This is not an investment or buy sell recommendation, but the valuation metrics could be deceiving. Okay, that's why we spent time discussing ROE, and we looked at it's the leverage, it's the high leverage in the case of State Bank of India that's driving this handsome ROE. Okay, so all the valuation metric it's low, but they have a lot of leverage. Okay, so you cannot obviously just trust valuation metric. Okay, all right, and then Kotak Mahindra Bank, it's a very conservatively run bank. It's just over 3, below 3 it would be a bargain. Okay, and again it has a very low leverage, and it has a decent ROE. Axis Bank, it's below 3, and ROE is very low. That is because they, if I'm not, they acquired the retail franchise of Citi, I think last year. So that's why their ROE they have the denominator is high. The return on the denominator equity is low. Again, but again, not getting there right on this video. So guys, again, so hope this was helpful. So this is how you should like evaluate banks. Okay. Yeah, and yeah, hope this was helpful, and I'll make a separate video when perhaps I can get into more details, and obviously I'll make a valuation video. But again, I would be, if in case you guys comment, then I would be willing to spend more time on those topics regarding bank or any other industry. All right. Okay. So yeah, so hopefully this was helpful and gave you some idea on how to analyze banks and what you should be looking for when analyzing banks. Thank you.